the global fund migration, funds that is migrating to India away from China. A surge of domestic and foreign investments are shaping the financial horizon in India's $4 trillion stock market as we speak. Investors across the world are turning to India's fast-growing alternative to China, undeterred by concerns over highly priced shares, upcoming elections, and regulatory uncertainties in India. Now, the influx of investments into India has lifted the benchmark Nifty, opening a new chapter with a 1/3 increase over the last 10 months that has attracted $20 billion in foreign inflows for the year 2023. And that's according to India's national depository data. And money is not just moving into India's equity markets, but there's a huge possibility that a lot of those money that's moving away from China could move into India's bond market as well, because bear in mind, India does have ambitious plans of lowering its fiscal deficit from 5.8% to 5.1%. And that could essentially mean that all these extra funds coming into India, getting into government securities or G-SECs, could also help fund our infrastructure ambitions as well. To talk about that more, I have with me Suyash Maheshwari, who is with me in the studio. Suyash, talk to us. This is a double-barrel gun, isn't it? This global fund migration that we're talking about, funds moving away from China, coming into India's equity market, and we don't have data for this as yet. That's the fact of the matter. Whether Indian government bonds or any form of Indian G-SECs or government securities, money coming into that from global hedge funds and global funds, who have evinced very clear interest in paring down their exposure to China. Because let's face it, China's stock markets have not been doing well at all. In fact, there is a $280 billion rescue package from the Chinese government to rescue China's stock markets. India's stock markets needs no such rescue whatsoever. It's on an aggressive bull run for nearly a year now. So tell us, how do you view this from all that you've been reading about this global fund migration into India?
I mean, just a decade ago, Krishna, the conversation was China plus one, and there were many contenders. Now it's China plus only one, which is India. Right? We are standing on top of all the competition.
Minus China, one plus one India.
I mean, the kind of returns that we have seen from the stock market speaks volumes, because, India is on an 8-year bull run. No other market globally has delivered positive returns for 8 years in a row as well. And even if even in 2023, remember, we are talking, in the latter half of 2023, we were talking about foreign institutionals leaving Indian markets. Still, they poured in $20 billion worth of equities in our market, right? And in terms of returns, we did not have the best of the year, but still we were like the third best performing market, apart from Japan and the US, right? And if you juxtapose it to what's going on in China and Hong Kong, they, after hitting the peak in 2021, have been skidding. The market has given negative returns since 2021, whereas Nifty has risen somewhere close to 30-35% in that same time period. And remember, it's not just the China, of course, they have their own problems. It's a property crisis that's going on. Of course, the stimulus package, the talks have been going on. There is none yet. And the global, in fact, the geopolitical tension also plays into factor. But India, for everything, has consistently shunned all those concerns. And of course, there are valuation concerns.
Yes.
But I think the investors are banking on, India's growth story. And when it comes to China, of course, since they have, declined or given a negative returns since the last 2.5 years, that brings us to that classic investor dilemma of growth that India offers versus valuation that China offers.
True. Okay, Suyash, before we get into any other further conversations on this, China's GDP growth rate, that's there on our screens right now, is also a telling a factor in terms of why global funds are even preferring India, because the fact that China could be a tapped out market, if I may, because they've been betting on China. Even conservative Japanese investors have always preferred having exposure to China over the course of the last 2 decades. And even we understand even these conservative Japanese investors too are paring down their exposure to China and increasing their exposure to India.
I mean, because there is no light at the end of the tunnel. We are waiting for a stimulus package. I mean, the talks are that stimulus package or rescue package is being worked at for the stock markets, where they are planning to bring in offshore money to pump up their own markets. But there is nothing about the entire property crisis that is going on. So clearly there are not enough measures taken to support the market that is slumping. Whereas again, coming back to our own markets, of course, the valuations are looking rather stretched, but India offers a lot of opportunities as well.
But it's at this stage, it's not about the valuations, isn't it? Because we're calling these as highly priced or overpriced valuation, but that's because there is still so much growth left. We don't know where the valuations could go from here on. Because let's face it, 3 years of 2 to 3 years of COVID, so we were still the fastest growing major economy through COVID and back, which means that as we are in the new world of post-COVID normalcy. The growth could only go up from here.
Definitely, and I think India has benefited from that, because a lot of businesses, because remember, China went through extended curves as far as COVID was concerned. Their bans, I think, if I remember correctly, only got lifted in early 2023, whereas since late 2021, India was pretty much like all our factories were pretty much working at full capacity, and the businesses were back in action. And in the last 2-3 years, not only we have seen that India corporate sector has kind of taken massive strides, but investor participation has also improved significantly. About only 2 to 3% of India just 3-4 years back was investing in stock markets. Currently that number is at about 8%. In developed markets, 40 to 50% of your local your citizens invest in stock markets. So we still have a lot of gap to cover.
True. Yes, as far as retail participation is concerned, we have a lot of gaps to cover, but the fact of the matter is that none of that seems to be deterring the foreign fund inflows into Indian stock markets, and that's what data has been telling us. And we were just looking at the returns given by all those stock market indices, and there's absolutely no comparison when it comes to the Indian stock market, the benchmark indices of Nifty and Sensex, and look at that 2.65 lakh crore rupees of FPI coming into India. Look at that, the Nikkei, which is the Tokyo index, up about over 30%, S&P 500 up 20%, Shanghai Composite down 14%, Hong Kong's Hang Seng down 24%, Nifty up 23. It's like, these things are going in two different directions altogether. Now, the only question I have to ask at this stage is that this is still trackable, because, you're talking about the stock markets and, you have an idea of, foreign fund inflows. But what about all that money that's possibly going into government bonds and government securities, Indian government bonds and Indian government securities? That's another separate aspect altogether, isn't it?
Of course. And, even as far as the budget was concerned, there was no sweeping announcements as such. But one thing that the government did put out was that their focus is now on reining in the deficit, right? And we were just talking about it in the newsroom. There are only two ways, there are two sides to the equation when you're trying to lower in your deficits. Either you reduce your expenditures. I don't see that happening, because government has been the capex, the capital expenditure push has been there, and since private capex is lacking, I think capex from the government will continue to move further, so they are not going to reduce the expenditure. So how do they bring down their deficit, right? The other side is your income. So as far as income is concerned, either you get it through the way of tax, and if anyone is following, there was no tinkering of tax this time around. Of course, I'm talking about direct tax here. Indirect tax, we are seeing a month-on-month increase as far as the GST collections go.
Yes.
But then another way of bringing in cheap money is to bringing the foreign funds. And I think one of the reasons, or I think one of the things that India is striving for is a better credit rating, because Fitch and Moody has India at the lowest grade of investment rating. So if investment, if the rating, the sovereign credit rating improves, we'll be able to get money cheaper. The cost of funds will substantially reduce, and that will perhaps compress that fiscal deficit that we are looking at.
Yeah, basically the question is, where are we going to get all that money from if we want to get that fiscal deficit down to 5.1%? And one clear way of money coming into India is definitely all these foreign fund inflows. But and that will happen, and that will happen only if the foreign funds are convinced with India's credit rating. And we here at News 9 have been talking about the kind of bias these global credit rating agencies have been having traditionally against India, and it's about time that they relook it. by virtue of what is happening with India's stock markets and the kind of foreign fund inflows coming into stock markets. There's so many global hedge funds and global fund managers are positive on India's stock markets. It better be a better credit rating as far as India is concerned. And we will continue to track that story.